I'm gonna be giving my friend Josh $100,000 to trade with.
Oh yeah.
This is episode 10 in the series where I'm teaching you how to become a consistently profitable trader. And so today, everything is kind of coming together and you are about ready, almost, to start actually trading.
Today's the day.
Today's the day. I'm gonna cover a couple more things that you're gonna wanna know. Now, we've spent the last 9 episodes, essentially, I've taken you from knowing absolutely nothing about trading to now you're at the point where you're almost ready to go. You're almost ready to actually actively start trading in the market.
It's almost that time.
And so if you guys want, you can head back to episode 1 and kind of progress through to episode 10, which we're on right now, to learn with Josh. And if you're interested in learning how to become a consistently profitable trader, the first link in the description will take you over to my website. That covers everything that is included in my mentorship group where I'm actively helping other students just like Josh learn how to become consistently profitable. So with that said, let's hop on inside my computer and go.
Let's do it.
Let's go. Okay, so we are actually finally gonna get you into some active live trading. However, not real capital. We're gonna start off through paper trading. And the idea here, and essentially the goal, is to not only learn, practice, obviously rinse and repeat everything that I've been teaching you over the last about 2 months, but to start collecting the data that we're gonna need to go about properly managing risk so we can make sure that in the long run, you're not only profitable, but you're squeezing as much capital you can out of each and every trade. So I have an algorithm I use to manage risk. It's a calculator that you'll have access to once we go about collecting data. And so I'm gonna have you go off on your own, spend the next 2 weeks taking everything that you've learned, start making trades. The goal isn't to make money. Obviously, you're just going to be trading on a paper account. The goal, like I said, is to learn, to practice, and to collect this data. But we need to set a baseline as far as how you are going to go about managing risk, because we want to be theoretical about this. We want to be realistic. And so if you have, and this is your plan, is to start with a $1,000 account, which is most people, and that's a lot of money for most people to start out with $1,000. But it is very hard to properly manage risk, but we'll set kind of a foundation to at least make sure that you don't blow up your account, as that's what happens with most people who start out trading, to get you on your way so we can collect this data so you can really take your trading to the next level. So this is how you're gonna go about managing risk, okay? Obviously, when you actually find that stock that you wanna pull up from my software, you look at the chart, you identify whether there's a setup there or not. You check off all those boxes and then set up your trade plan, stop loss, take profit, bring that trade into the Analyze tab. You simulate out that position and then you figure out the risk reward in the contracts. Well, this is the criteria we're going to go based off of. So you're going to have, theoretically, you have 100,000 in paper money, but we're going to size and we're going to trade as if you only had $1,000. So your account size is $1,000. Your position size is $500. That's 50% of your account size. That's the problem with having it's a little aggressive, right? That's the problem with having a small account. But here is how we're gonna, make sure that as long as you're sticking to your trade plan and you're calculating the risk to reward out and you're making sure that you're within this criteria, you're not gonna blow up your account. You're gonna be able to actually put on trades, as most option contracts cost at minimum $100. So your minimum R to R, which is your risk to reward, or your R, however you want to say it, is going to be a 1 to 2, which means you're risking essentially 1 part or $1 to make 2 parts or $2. And then your optimal risk to reward, this is what I really want you to shoot for, is going to be a 1 to 3. Okay. And here's what's very important. Your downside and your upside. Now this is in percentages. So your 1 to 2 is going to be a 10 to 20. That means you're not going to lose more than 10% on those contracts, whereas you have a 20% potential to make 20% profit on that contract, as long as it is within that $500. So you can buy 1 contract for $500, you can buy 2 contracts for $250. But when it comes to your trade plan, when you go about setting up your stop loss, your take profit, you're gonna have to manipulate and essentially go through as many contracts as you can to find contracts that present that downside of 10% and that upside of 20%. Now, your downside has to be under 10. It can't be above 10. Theoretically,
10% of what?
Less than 10 of the actual, and we'll get into Thinkorswim and I'll give you some examples, but of the total position size. So out of that $500, you want to keep that downside under 10%, theoretically as small as possible, right? You're not going to be at exactly a 1 to 2. It's not going to be exactly 10 and 20. That's going to be almost impossible. But say this is 7 or 8 for the downside, and the upside, theoretically, you want this to be as high as possible or a little bit over 20. Like, we got to go about setting realistic expectations. So let's say the upside is 20 or above. Okay, the downside is 10 or less. So within that 1 to 2, again, there's going to be wiggle room on either side. And then the optimal RR is going to be a 1 to 3, and that's going to be a 10 to 30. Okay? Now, you're going to go about taking each trade. You're going to have to spend a lot of time running through, simulating the contracts, finding the best contracts that present that 1 to 2 or 1 to 3. And then you have to stick to your trade plan. You have to get out exactly where you plan on getting out, whether that is for a win or a loss. Stick to that trade plan so then we can have some consistency, start to build up that data that we're going to take, because we are essentially going to be looking to collect what is both going to be your win rate per setup. So we're going to have your win rates per the 3 setups that I teach, and then your win rate altogether. So when you combine all 3 setups, and then your average winner and your average loser per setup, and when you combine all the setups.
Okay.
Does that make sense? So that's, once we have all that data, we'll go about getting that actual win rate, the upside and the downside. You have your trade journal that I set you up on. So that is all essentially going to be automated besides collecting the upside and the downside. So let's run through the whole process.
Okay.
Right now.
do
Let's
it.
run through the process A through Z and send you off. And over the next couple of weeks, you're going to start taking trades and collecting that data. So I'm going to let you take over. And step 1, obviously at this point, you know how to use my software. You've taken the curriculum I put together, teaching you how to utilize the software just as I do, how to trade with it. And now you're going to go about actually going through the sweeps, pulling up the stock, identifying whether there is a trade there or not, and then setting up that trade plan, running through the risk to reward, simulating the position, seeing if it's within that criteria as far as managing the risk, and then putting on that trade.
All right.
All right. So let's first just start off by going through, how about the most recent sweep that came in? GDDY. Why are you going,
Could be an all-time high pullback.
Okay, so one of the setups that you've learned out of the 3, this chart you think presents. So let's run through kind of what we're looking for in an all-time high pullback. And do you want to use that? Did you write down the checklist I sent you?
No, I have it on here, though. I was trying to add it to the playbook, but I didn't know how to add it.
I'll show you. We'll get your playbook set up.
Can we read it off of this?
Yeah, you can read it.
So we're looking for a bullish trend. Check. Sitting at the all-time high or just below. So we're sitting just below at 103.49. And then the all-time high actually just formed. Perfect. 15-day EMA currently respected. Correct.
Either one needs to be respected.
Okay, one or the other.
Yeah, and then it goes, because that's going to essentially define how you're going to go about managing the trade. So if you look at the trade management, then we can decide based off whether the 50 or the 15 is respected, how we're going to manage the trade. So it looks like everything that we're looking for here is pretty solid. And I think I have like a 76% win rate right now with the ATH. We want to look at the margin for profit between where we're trading to the 15-day and then to the 50-day. And then from where we're trading to that 105.47 ATH. So that would be your stop loss at 105.47. Slightly above, remember the rules, something that you learned in the master class.
It's like 2% above.
Okay. So right above that area.
And then down to the 15-day.
So yeah, down to the 15-day would
That's only
theoretically
like a
be your target.
1.2. To the 50-day, looking at 7.
Now let's look at the trade notes. Let's look at the trade management. So we can play a break below 15 and short to 50. All right. We can play short off the ATH down to the 15,
Which would be that 1%.
which is 1%, or we could short off ATH down to 50, which depending on the chart, this chart, obviously we'd short through the 15, which is support. Or we can play the break below the 15 and short to the 50, which is support. So right now where we're currently trading and it being 240 already, if the risk management aligns with what we're looking for, well, let's set up our target. So in this case, we'd short off the ATH down to the 15. I would say in this scenario, based off of this chart, the 15-day has been very respected, and we could easily see a continuation of this pattern again and short down to the 15. I think a break below, actually breaking this pattern, breaking below the 15 and shorting to the 50 is not going to happen when we look at moving averages on this chart being respected. We have not broken below the 15. So maybe there's not going to be enough margin for profit. And what would happen is that we're actually going to end up risking more than we could even make. So let's set our target at the 15. Okay. Now we want to set it slightly above the 15, remember.
Oh, yeah.
So when it comes to being short, we want to set our stop loss slightly above resistance to give the market that chance to probe that area. People get shaken out, it retraces. And then when it comes to our take profit, we want to set it slightly above support at 102.24. Okay. Just give it a little space on the top. Okay. So let's go to the 1 minute just to get some kind of reference. Just zoom out on the 1 minute. I just want to look at today. So there you go. Generally, that's obviously we're not ever doing our work on the 1 minute, but it's good to look at. It just gets you more familiar with the actual chart and how it's been trading on the day.
Sounds good. So now analyze. Risk profile. So first I have to take in my stop loss, which is at 105.59 right there. So I put that in under the strike price.
Yep.
And then I have to put in my take profit, which is at 102.24 right here. So enter that and then go and actually look.
Go back to the software. So this guy just bought up the GDD $100 strike puts, obviously, expiring January 19, 2024, 102,000, and he bought them for $155 a contract.
Okay, so
January 19th, 2024. So let's pull up the Jan 19th, 2024 contracts and the $100 put.
just out of the money.
So let's buy one of those, simulate it, and I would go back right now. Oh, you are good. Stay.
I just want to see like the volume.
Good.
and stuff.
I was gonna tell you. Yeah. So look at the volume. Obviously, this is in the actual live market. We're not simulating this yet because we want to reference the volume to make sure there's enough volume on the contract. So you can kind of look at the 100, the 97.50, the 92s, the 105, and just make sure there's actual trading happening, right? Mm-hmm. We obviously want to look and see. These contracts currently are trading for 155. Let's just go back and reference what this guy got filled at. So he got filled at 155. So he's even, he's flat on this trade. Obviously gauging certainty, gauging risk. Okay, a little more conservative. Expiration is about 2 months out. He's one space out of the money. And this is a smaller cost, okay? 102,000. 158 they're trading for on the low end. So they're going up a little bit. So let's go to the Analyze tab.
Add simulate trades. Go to January 19th, 2024 for the 100.
158. You can change that too. Good. One contract. Now, let's just use my data because setting the trade plan up, doing everything, that I do, you're going to be sitting at around a 3 to 5 day hold period. So we want to go as far out as possible. So let's go 5 days. That's the longest amount of time we'd end up holding a trade based off of our averages. And we'll run the risk reward based off of that day. So 5 trading days. So today's the 6th. So Thursday, Friday, 13th. Yeah. Well, 5 trading days, not including today.
Okay.
So the 13th. So you could be in the scenario where you end up holding this trade over the weekend. Do keep in mind that, based off the chart, we want to prepare for the worst case, as in the worst risk reward. If we get stopped out a week from now, 5 days, knowing options, it's going to cost us more and more every day because theta. And so as long as our risk reward is going to be good, like kind of the worst case, then we can enter it. But obviously if we get, if we hit our target tomorrow, we're going to make way more than we would if we hit our target in a week. But we want to go as far out as possible. So we have the flexibility to know that even if we get stuck in this trade, even if it takes longer for that move to happen, whether we get stopped out or take profit, it's still within the risk reward as far as the trade we could take. Because the risk reward is going to change each day. And that's the way I've found to work the best for me.
Okay. That makes sense. So doesn't look like a very good risk.
So yeah, you can see obviously our
It's a 3-to-1, not a 1-to-3.
Our downside is going to be $66.91, and our upside is going to be $22.97. So it's a flip risk to reward.
Yeah, not good.
That's not good. What would you do in this scenario?
Do you look at other contracts?
We can go about simulating more contracts. However, just keep in mind that if you're so far away from, that baseline, that 1 to 2 or the optimal, the 1 to 3, I mean, we more than likely won't be able to find contracts that fall within that risk reward that we're looking for.
So on to the next
And then
sweep.
keep in mind, like, you also have to look at the upside and downside percentage. And these contracts are only trading for $158, $67. That's a $67 loss on a $158 contract. That is whatever the percentage is. And that's going to be substantially outside of your 10%. Does that make sense? So yeah, unfortunately, this seems like it might not be a trade we could take. However, you can go through and manipulate out more contracts to see if you can find that optimal risk to reward. But I'd say, for the purpose of this video and learning, let's move on to the next sweep. So if you want to go back to the software, and then we can go to JWN. So really choppy.
No moving averages are respected.
No moving averages are respected. You're right.
On to the next. Nova.
That looks very similar as the last one.
Nothing.
I don't see anything either. The next step, and let's go back to GDDY and use this as an example, because the next step, and let's say theoretically, this trade looked great. Now we're within that 1 to 2, 1 to 3. The upside and the downside percentage aligns with obviously your risk management. Well, now we can go about actually putting on that position, buying those contracts. So theoretically, let's just say you could have bought one contract. And what we're going to do is we're going to then put that position. We're going to export that position out of TOS, drop it in your trade journal. We're going to go about logging that trade. Okay. And then collecting that data we need to collect. You might end up entering this. You might hold it for the next day or 5 days. You manage that trade exactly according to your plan. Okay. Stop loss, take profit. Again, don't focus on and don't worry about losing money, even though it is paper money. Like, one thing we're going to get into when you transition into live capital is going to be really the psychological element and aspect of trading. Like, trading psychology is a huge part of trading that you'll have to really conquer. But like I said, the purpose of this is technical analysis. It's collecting this data we need to properly manage risk. Even though you have a small account, if we have data, we could properly manage risk, in my opinion. There'll just be less opportunities you can take because a lot of the trades that might look good, they're just going to be outside of that range as far as, like, you can only put on one contract, or you couldn't even buy a half a contract. Right?
Yeah.
Does that make sense? What I'm going to do is I'm going to let you go off on your own. I'm obviously going to make sure that you're all set with your trade journal to actually start tracking this data and logging it. And then you're going to come back, and in a couple weeks, we're going to touch base. We're going to look at all your data. We're going to look at your win rates for each trade. Okay. We're going to collect the average winner and the average loser. We're going to look at this data, and then we're going to make a decision on how to go about moving forward and transition into trading with live capital. So that's the goal. So let's fast forward theoretically. Let's say you have now taken that trade. You got out of that trade, in this case, for a loss. And the next step is essentially just going to be to go to your monitor tab. Now you can type in the symbol of that position, or just, if that's the only trade you took on the same day, you'll see it right here. Go up here, click on this, export file. Okay, wherever you want to save this, I'll save it to my desktop, and then test file, and then save it. So now you exported that CSV, and now let's go over to your trade journal, and you're going to go to add trade. Obviously, add to this portfolio my trades. You're on Thinkorswim. You're going to upload that file, open, and there you go. So that is automatically going to import. Now you're going to have your net P&L, and we can just have all the data that we are going to need besides the average winner and the average loser in percentage that we're going to have to go back and manually just track. So if we go to trade log, you have to go click on the trade, go to playbook, select your playbook, say there's the ATH bounce. And now if you go to playbook, you'll see your ATL bounce, sorry. Now under your playbook, you can see your ATL bounce. You've got one trade and a total win rate of 0%. That's how you're going to do this. Moving forward, we're going to touch base in like 2 weeks. I'm going to let you go off on your own. You're going to come back. I'm going to look at your trade journal. We're going to end up getting, obviously, your win rate, overall win rate, your win rate per setup, your average winners and losers per each setup, and then overall when we combine them. And then we're going to move forward, depending on that data, either into trading live capital and managing risk with my risk management algorithm, which you'll have access to, which we'll cover. And then, yeah, that's kind of the next progression. And right now, the goal for you is to go out to practice,
Get some data.
get data, just continue, rinse, repeat, and implementing everything that I've taught you over the last 2 months. And you've had like a very fast-tracked way of learning, and it's been not as easy as we thought to record, document, make sure that you guys are going along at the same pace. You're able to follow along with Josh. I've thrown a lot at you, and you really need to just now sit back,
Use what I've learned.
use what you've learned,
Put it into play.
and put it into play, and we'll see, what your data looks like, and we'll go from there. Does that make sense?
Makes sense.
All
I'm
right.
excited. Finally get to start
Trading.
doing some stuff.
You do. All right. Awesome. Well, again, if you guys are interested in my mentorship group, the first link will be in the description below. You can head over to my website and see everything that is included and apply if you'd like to do so. With that said, subscribe for more. Stay tuned to see how Josh ends up doing after 2 weeks of paper trading. And we'll see you guys in the next one. Later.